The Commercial Real Estate Show is brought to you by Resnick, forward-thinking advice to navigate business and financial issues. Visit CohnResnick.com. By BB&T, banking, business, and commercial real estate loans. Visit BB&T.com. And Arnold Golden Gregory, a law firm that makes a difference. Visit AGG.com. And Bull Realty, when your business requires proven performance, visit BullRealty.com. And by France Media, providing exposure to the world of commercial real estate. Visit FranceMediaInc.com. Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of company you work with and laugh. I believe we have to have some fun along the way. Well, hello, I'm Michael Bull, your host to the world of commercial real estate. You know, we're honored to welcome some new stations to the Commercial Real Estate Show family. We're now on the air in Miami on 880 The Biz. In Orlando, your hometown station, 1520 WBZW. In Houston, on Business 1110 KTEK. In Dallas, we're on AM 1160 KVCE, Dallas-Fort Worth's Business Authority. In San Francisco, on the Bay Area's business leader, AM 1220 KDOW. Also, we're in Sacramento on Money 1055. In Seattle on Money Radio 1300 KKOL. And we're in Honolulu. I'll have to get out there and visit on KGU. You know, if you're hearing the show for the first time, you're invited to use the show website, commercialrealestateshow.com, to get to know us a little better. We sure appreciate you guys listening in those cities. Well, today we're going to look at strategies for banks and other lenders related to non-performing notes and OREO, which of course is other real estate owned or foreclosed properties. We're going to share some best practices that are working well for banks and other lenders to maximize recoveries related to land, apartments, and commercial real estate. And of course, if you know what works well for banks, you know better how to work with lenders if you have a problem loan, or if you invest in distressed real estate, or if you have some interest in the industry. Well, let's start with a look at the health of U.S. banks. Please welcome my first guest, Chris Marinac, Principal and Director of Research, FIG Partners. FIG Partners is an employee-owned broker-dealer specializing in financial institutions. Their expertise includes independent research on bank stocks and the industry at large, raising a new capital, and providing strategic advice for banks nationwide. Chris, thanks for joining us today.
Thanks, Michael. It's great to be here.
Well, we appreciate you being with us, Chris. And, you know, the banks have been through a tough time for the last several years. They're obviously a very important part to our economy and our recovery. Just how are banks doing right now?
Well, the profitability in 2012 is substantially better. Right now, as of the end of September, 91% of the banks are profitable. Some banks are making money and are profitable by virtue of having reduced loan loss provisions. So if we take that out of the equation, still about 85 or 86% of the banks in the country using the FDIC charters, over 7,100 banks, are in fact making money. So we think that's a very positive shift and certainly a dramatic difference from where the industry was sitting in 2009, 10, and early 2011.
And how much better is it, to put it in perspective?
Well, everything's relative. If you go back 6 or 7 years, the industry was making 14 to 15% returns on equity. That no longer is the case. We're closer to 8 or 9 for the companies as a general rule. There is a big spread all over the map. There are still several companies who are very small on profitability. We have less leverage today, so the overall capital that's being put into the industry is much greater than it was. So therefore, there's less assets per dollar of capital than there was in 2005 and 6 before the recession set in. But we are seeing companies return to profitability. I think we're going to be a ways away from peak profitability. We have low interest rates. We still have the recovery of loans. There still is some workout of credit issues, which we're going to talk about a lot here on the call today. But I think that there is still a shift of profitability on the upside, which is much different than it had been before.
Okay. And how many banks failed in 2012, and what do you expect for failures in 2013, Chris?
It's interesting, Michael. If you go back the last 5 years, we've had 467 banks fail. Now, in 2012, only 51 failed. So the bulk of the failings happened in 2009, 10, and 11. And so this year, I think we're still going to see a downtick. Much like we saw in 2012. My prediction would be 25 to 30 banks fail. I say that because as of the end of September, there were 38 institutions across the entire FDIC platform that had capital less than 3%. In my opinion, the FDIC will not fail all these institutions. They will let several of them muddle along. I think you will have some failings this year. It typically is going to happen at the end of the reporting period, such as the end of January. You'll have a few of them because the FDIC does not want them to file their call report. You'll have a few more in April, a few more in August, et cetera.
Okay. And are the national, regional, and community banks faring any differently?
Sure. The national companies, I think, have the best profitability. I think your regional banks are also doing well. In my sense, the community banks, there's definitely a dichotomy. Some community banks are still struggling. It is not going to be a fun time for them, even though they are making money. Technically, it is not where they want to be, and I think there has to be some structural changes to their operations and their approach. Having said that, compared to where we were in 2009 and 10 and early 11, we are markedly better than we have been. I think that it's important to remind ourselves that even though there are 7,100 FDIC chartered institutions with deposit insurance around the country, that 2% of these institutions control 80-some% of the assets. We still have several banks that are small, less than $500 million in assets. They are teeny tiny banks in some respects, below $100 million in a lot of cases. So those smaller banks can kind of skew the statistics. When you really look at the dominance of the larger banks in the country, those banks by and large are very healthy. We are slowly but surely getting the community banks up the profit chain in terms of recovering from where they've been.
Okay, so you expect a positive improvements in the banking industry in 2013?
I do. I think there are some challenges out there which we can discuss, but I do think that the profits are getting better.
Okay. And what about non-performing loans and foreclosures? Are banks out of the woods yet?
Well, out of the woods is probably a strong statement. We still have recovery happening. I think we're still, another year and a half away from getting back to ideal levels on problem assets. Mm-hmm. It is definitely improving. Both the absolute level of problem assets continue to fall. The amount of OREO is falling. I do think it's falling faster at the larger companies than at the smaller community banks, but I do think it is on the move downward. The sort of threat of a recession or threat of concern about the election and the fiscal cliff, the tail end of last year, I think put a lot of things on hold. I think that uncertainty is now behind us. While no one's necessarily happy, I think we do have the uncertainty removed and the businesses are moving forward. I think low interest rates are helping a lot to sort of keep things moving and have the recovery take place. We think it's going to be slow this year, but we do think things are going to be positive.
Okay. And there's certain types of loans or properties that are causing more issues for banks than others?
Right now, I think you still have the overhang of land, the overhang of residential construction in certain areas. It's very much a street corner basis. I think that office buildings probably still have some structural issues to them in terms of finding tenants as well as finding lease and rent growth. Other areas such as multifamily are the exact opposite, which are very strong. Hotels have been surprisingly good. Industrial seems to have come back. Retail is spotty, but I think that's always been historically sort of a case-by-case basis in retail. Okay.
And how are banking regulations and the FDIC affecting banks these days?
Don't ask. It's not a fun topic. Unfortunately, the regulators are judge and jury. They're making it very difficult. We've had some new legislation the last 2 years with Dodd-Frank that makes it very difficult. None of us like it, but it is what it is. I do think that it is going to create some clarity for companies who want to stay in the game of banking, that they're going to have to play by a new set of rules. Unlike a football game where you change the definition of a penalty, the banking real system doesn't have any chance to appeal, and it's going to be forced on them and sort of crammed on them. But it is something that is going to happen and is unfolding. We still have many rules and regulations within Dodd-Frank that are going to be laid out and put into action in the coming year. A lot of it's nebulous stuff that you wouldn't get into, and it applies to all kinds of other rules and compliance issues, but it's going to make life difficult for banks. Unfortunately, I think that banks simply have to bite their tongue and move forward. It is going to create some consolidation. There are many banks and board of directors who are unhappy and are tired, and they will exit the business. We think that the pricing is beginning to change ever so slightly so that it's making more sense for companies to sell. We are seeing stabilization of equity and book values in the business, both for private and public companies. That's becoming very healthy to at least begin the conversation about more mergers. We've had a couple of examples of mergers the past year and a half that are worth hanging your hat on just to use as guideposts to the future.
Okay. And this seems like an excellent time for banks to do loans, especially in the commercial real estate world. Probably some of the safer loans they're going to do in the last 10 years. Are banks starting to really lend more?
Absolutely. Yeah. Banks have been lending more since the summer of 2011. We've seen the amount of loan growth improve. The challenge for banks is that they're not making a lot of money on these new loans because interest rates are low, spreads are low. Historically, when interest rates are high, banks can make more money. It's very difficult for banks to make the same spread that they used to. Therefore, they have to be careful with the loans they make. We think there's a structural challenge for banking right now in that the amount of cash flow coming off of existing loans paying off, securities that are paying down. Securities are paying down because many of the banks are using mortgage-backed securities today, which are prepaying through natural refinancing. All that cash flow from both the loans and securities is pushing banks to reinvest those funds and come back into the marketplace with new loans and investments. Banks have to make those loans, but they're making them at lower spreads, which is a challenge for the future. I think that one of the offshoots is that banks are beginning to consider their cost structures on the operating expense side. You're also seeing mergers begin to show examples of how a merger could actually be very profitable for a bank day one versus 10 years ago, it was very much a challenge to see a merger be profitable the first day.
Okay. Well, we're going to have some more information from Chris Marinac on the banking industry. We also have some other special guests joining us that you don't want to miss. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back.